Verizon, America's largest wireless carrier, 115 million plus retail connections, and 99+% population coverage on nationwide 5G.
A $53 billion bet on C-band spectrum, the biggest wireless auction in U.S. history, and they are still building out the network today.
6.44% dividend yield, 22 straight years of increases, $11.1 billion paid out to shareholders every single year.
This is an income stock first, a network infrastructure giant second, and a convergence story third. Here is how all three fit together.
The roots go back to 1983. Bell Atlantic spun out of the AT&T breakup as one of the original baby bells.
In 2000, Bell Atlantic merged with GTE to form Verizon Communications. That is when the company hit the New York Stock Exchange and became one of the largest telecom listings in the world.
2005, Fios Fiber launched, putting Verizon into the broadband race. 2009, Verizon built the nation's first commercial 4G LTE network. They have always been the network-first operator.
2014 was the big one, $130 billion to buy Vodafone's 45% stake in Verizon Wireless, full ownership of the crown jewel.
2021, they won $52.9 billion of C-band spectrum at the FCC auction. Same year, they sold Verizon Media, Yahoo, and AOL to Apollo for $5 billion to refocus on the network.
And just this January, the Frontier acquisition closed, adding 22 million fiber passings to the Verizon footprint and cementing the convergence play.
Total revenue for fiscal year 2025, $134.8 billion. Consumer wireless is the engine, and wireless service revenue is what really drives the print.
Consumer wireless alone delivered $79.4 billion, nearly 59% of total revenue. Business solutions added $29.8 billion. Wireline broadband chipped in $12.5 billion.
Fixed wireless access pulled in $7.2 billion and is growing fast. That is the segment to watch. It sits on spectrum Verizon already owns.
Now the unit economics. Postpaid phone ARPA average revenue per account is $139.77 per month, up 1.4% year over year. Postpaid phone churn is 0.89%.
That churn number is some of the tightest retention in the industry. Customers do not leave Verizon. And that is the moat math you cannot replicate with marketing dollars.
Run the line economics, roughly $45 to $50 per line, times 115 million plus connections. EBITDA margin sits at 33.8%, up 0.2 points year over year. CapEx is running 14.3% of revenue during the C-band densification phase.
Now the dividend story. 22 consecutive years of increases, $2.71 per share annually, $11.1 billion in total payout. At a $42 share price, that yield is 6.4%.
This is an income stock first. Retirees and income investors hold it for the yield, not the price chart, and that is exactly how management runs it.
Here is the discipline. Even while spending $53 billion on C-band spectrum, they never cut the dividend. Free cash flow conversion is the entire game. The payout has to be covered every single year, no exceptions. In 2025, that math still worked, with room to spare for a 23rd straight raise.
And the moat, $52.9 billion of C-band spectrum, 99+% 5G population coverage. No competitor can replicate that spectrum position quickly.
Frontier adds 22 million fiber passings. That is the convergence play, wireless and fiber sold together. And fixed wireless access at roughly 10 million customers is profitable incremental revenue on spectrum they already own. Hans Vestberg runs Verizon. Swedish, trained at Uppsala University in business and economics, and a pure network infrastructure operator at heart.
He spent 25 years at Ericsson, chief financial officer, then chief executive from 2009 through 2016. He knows wireless infrastructure better than almost anyone alive.
Joined Verizon as chief technology officer in 2017, took the chief executive seat in August 2018, and was named chairman shortly after.
The $52.9 billion C-band bet was his call. He staked the company's future on mid-band spectrum, and the densification we are watching today is the payoff.
His framework is the network as a service. Sell connectivity as a platform, not a commodity. The career trajectory tells you everything you need to know. A pure network infrastructure operator from start to finish. That's the company, the operating model, and the leadership. Now let's get into the numbers from this quarter.
Starting with the headline print.
Verizon just printed Q1 2026 before the bell. EPS 128 versus consensus 121, a clean 7-cent beat. Revenue $34.4 billion, missing by $420 million. Stock up 3.6% to $48.05.
And the market's verdict is loud. A company that traces its roots to the 1983 AT&T breakup just got rewarded for margin discipline over top-line growth. The buy-side chose EPS quality over a wireline integration revenue hiccup.
That's the whole story in one trade. Let's unpack it.
First full quarter with Frontier consolidated, roughly $2.2 billion in wireline revenue rolled into the print, and that's the line the street is still learning how to model.
Fixed wireless access net adds came in at 320,000. Total FWA base now 10.3 million customers, running ahead of the internal cadence Hans laid out at the last investor day.
But postpaid phone net adds were thin, roughly 100,000. T-Mobile is still winning the absolute net add battle every quarter, and that gap isn't closing, it's actually widening on a trailing 12 basis.
The revenue miss matters less than the optics suggest. Strip out Frontier integration seasonality and a couple of business solutions timing items, and the organic wireless service line is doing exactly what management said it would.
Which is why margins held. EBITDA margin 37.1%, up meaningfully year over year. Cost discipline is real, and the synergy capture on Frontier is tracking to plan in Q1.
So the headline is revenue light, earnings heavy, mix improving. That's a quality print disguised as a mixed one.
Total revenue $34.4 billion versus consensus $34.82, down 1.2% versus expectations, but up about 4% year over year on a reported basis once you fold in Frontier.
The line that actually matters, wireless service revenue, came in at $21.3 billion, up 2.5% year over year. That's the organic quality signal, and it's right in the middle of the 2 to 2.5% guide range.
Consumer wireless held the franchise together. Postpaid phone ARPA ticked higher again, and churn stayed below 90 basis points. That's the income engine doing its job.
Business solutions was softer. Some enterprise timing items pushed deals into Q2. Management flagged it on the call as a calendar issue, not a demand issue.
Wireline contributed about $12.5 billion all in this quarter, with Frontier's $2.2 billion folded in. The integration accounting is going to be noisy for the next 2 or 3 quarters. Every modeler should expect that.
EBITDA, $12.75 billion. Margin 37.1%, up about 200 basis points year over year. That's the cleanest number in the print.
CapEx came in at $4.3 billion, tracking the roughly $17.5 billion full-year guide. C-band densification spend is moderating now that the urban builds are largely done.
Free cash flow $4.25 billion in the quarter. Dividend coverage was about 1.48 times, comfortable, not stretched, and the payout absorbed $2.87 billion of that.
EPS 128 versus 121 estimate. Beat driven 60% by margin, 40% by below-the-line items, lower interest expense as some debt got refinanced into a friendlier rate window.
Management reiterated the full-year adjusted EPS guide of $4.60 to $4.80 and held wireless service revenue growth at 2 to 2.5%.
Even on the forward EPS projection, the street is carrying $4.65 for the year. Verizon trades at roughly 10.3 times forward earnings. That's a telecom cheap multiple for a business compounding mid-single digits with a coverage ratio above 1.5.
Net debt $181.5 billion, 3.8 times trailing EBITDA, up sequentially because of Frontier, which is exactly what you'd expect.
So the math, organic growth holding, margin expanding, leverage temporarily elevated, dividend covered. That's the quarter in 5 lines.
A clean print under the hood, even with the headline miss.
5 bull pillars. Pillar 1, Frontier Fiber compounding. 22 million passings adds a churn reduction lever that pure wireless can't match. Convergence customers churn at roughly half the rate of wireless only.
That math is enormous. If Verizon can convert even a third of overlapping wireless households into fiber plus mobile bundles over 3 years, the lifetime value reset is worth multiple billions in NPV.
Pillar 2, fixed wireless access scaling. 10.3 million today. The company has guided toward 12 million by year-end 2026. Critically, this is on owned C-band spectrum, so the incremental margin is wireless-like, not cable-like.
Pillar 3, C-band densification driving ARPA ceiling expansion. Higher capacity per cell means the premium unlimited tiers actually deliver, which is what justifies pushing ARPA above 140.
Pillar 4, the dividend compounding. 5.76% yield today, 22 consecutive annual increases, and the FCF coverage gives room for 2 to 3% annual growth. That's a 10% annualized total return floor before any multiple expansion.
Pillar 5, rate normalization. Verizon trades like a bond proxy with a beta of 0.27. When the 10-year compresses, this stock re-rates mechanically. Every 50 basis points of rate compression is roughly a 1 to 2 turn multiple lift, historically.
Stack those 5 together, and you have a thesis where you don't need any one pillar to be heroic. You need 3 of 5 to play out.
And catalysts on the calendar. Investor Day later this year, Frontier Synergy Update at Q3, and the ongoing FWA cadence print every quarter.
That's a setup where time is on the bull's side, not against it.
As long as the dividend is covered, you get paid to be patient.
5 bear pillars. Pillar 1, T-Mobile keeps winning postpaid net adds. Verizon at 100,000 this quarter, T-Mobile likely to print north of 700,000. The share gap is structural, not cyclical.
Pillar 2, leverage. $181.5 billion in net debt, 3.8 times EBITDA. In a higher for longer rate environment, every refinancing cycle hurts. Each 50 basis point move on debt service is roughly $400 million in annualized interest.
Pillar 3, Frontier integration execution risk. Telecom integrations are notoriously messy. Synergy slip of even 12 to 18 months, and the deal math gets uncomfortable, especially given how much of the bull thesis leans on convergence.
Pillar 4, CapEx intensity. Management guided to 14.3% of revenue, but if 6G timelines pull forward, that number stays elevated through 2028 or 2029, pressuring the FCF line that funds the dividend.
Pillar 5, wireless pricing pressure. Promotional intensity from T-Mobile and a more aggressive AT&T means ARPA gains may slow. Cable MVNOs are also pulling share at the low end of the postpaid market.
The bear thesis isn't that Verizon falls apart, it's that it gets stuck, slow growth, high leverage, dividend technically safe, but multiple compresses to 9 times forward.
Stuck stock risk. That's the real bear case.
And honestly, the last decade of stock performance is the bear's exhibit A.
Versus the rivals, AT&T, T-Mobile, and Comcast, Verizon sits in a very specific lane. T-Mobile is the growth name, trading near 18 times forward earnings, mid-single-digit revenue growth, sub 1% dividend yield.
AT&T is the closest comp. Trades around 8.5 times forward, similar yield profile, but with a smaller fiber base and a less coherent capital allocation story post-Warner Media unwind.
Comcast is the convergence rival from the cable side. Trades around 9 times forward. Their MVNO is taking share, but they don't own spectrum, so the long-run economics favor Verizon if convergence really matters.
On yield, Verizon's 5.76% is the highest of the four. AT&T's around 5.1%. T-Mobile's a rounding error, Comcast under 1.5%.
On growth, Verizon's the slowest. T-Mobile leads, Comcast in the middle, AT&T and Verizon at the back.
So the positioning is clear. Verizon is the income quality play. You buy AT&T if you want a cheaper version with more execution risk. You buy T-Mobile if you want growth. You buy Comcast if you think cable convergence wins.
Verizon is the answer for the investor who needs the coupon and trusts the network moat to defend it.
Options market priced a 3.8% implied move into the print. Actual move was 3.61%. That's a remarkably well-calibrated setup, almost a non-event for vol traders.
Put-call ratio sitting at 0.82, mildly bullish. Open interest in the May 48 calls built meaningfully into the print, which suggests positioning was leaning long earnings.
Insider activity has been minimal, just RSU vesting sells, no open market buys in the last 90 days. Not bearish, just neutral.
Short interest is the more telling line, declining from 2.5% of float 12 months ago to 1.8% today. Quiet capitulation by the bears.
The core tension is simple. Bulls own Verizon for the coupon and the convergence option. Bears worry the growth never reaccelerates and the multiple compresses anyway.
For bulls to be right, frontier synergies have to land, FWA has to keep scaling, and rate normalization has to do some of the work. 3 things, none individually heroic.
For bears to be right, T-Mobile keeps taking share, rates stay elevated, and frontier integration slips by a year. Also 3 things, also plausible.
That's why the stock is range-bound at 10 times forward. The market is genuinely undecided, and that uncertainty is reflected in the multiple.
Sell-side consensus sits at hold to moderate buy. Roughly 30 analysts covering 11 buys, 15 holds, 4 sells. Average price target $49.50.
That target implies about 3% upside from current levels, which honestly understates the total return profile once you add the 5.76% dividend yield.
The dispersion is the more interesting tell. Low end 42 from a couple of bearish desks worried about leverage. High end 60 from Raymond James, who has outperformed and frames Verizon as a convergence winner.
Goldman is at buy with a 55 target leaning into the FWA scale story. Barclays sits equal weight. JP Morgan stays neutral, more cautious on integration.
So the smart money is split, but the modal view is patient hold with yield. That tracks the fundamentals.
3 or 4 metrics to track every quarter going forward. First, wireless service revenue growth rate. The floor is 2%. Slip below that, and the entire bull thesis cracks.
Second, postpaid phone net adds. We can stomach thin prints. We cannot stomach negative prints. Watch for the trend turning red. That would mean cable MVNOs are taking real share, not just churn share.
Third, net debt to EBITDA. 3.8 today, needs to trend toward 3 by late 2027 as frontier synergies compound. Any sequential rise from here is a yellow flag.
And fourth, FWA quarterly net adds. 320 this quarter is healthy. Watch for that number to stay above 250 per quarter to validate the path to 12 million by year end.
My one-line thesis. Verizon is the highest quality income compounder in U.S. telecom, but you have to be honest that it's an income story first and a growth story a distant third.
My one line, trade by trade, this is a coupon clipping franchise where the convergence option is free. 10 times forward earnings with a 5.76% yield and dividend coverage above 1.5. That's not a stock you trade, that's a stock you own.
As always, this is 1 quarter of data and 1 perspective. The thesis lives or dies on the next 4 prints, not this one.
Before we close, this content is for informational and educational purposes only and should not be construed as financial advice. All investments carry risk, including loss of principal. Do your own research, consult a licensed advisor.
For more deep dives on the names that move the market, head to chargedalpha.com. We publish a new episode every week.
Chargedalpha.com. Hudson and Lana, signing off.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.